By Leanne Jones from Bell Direct. Leanne, it's always great to have you on the program. Let's kick off with your thoughts on the session.
James, look, unfortunately it was a fairly disappointing session, I think, particularly given the fact that we had some pretty positive leads coming from US markets on Friday. And of course, we also did see some strength around the region. So I think the fact we saw those falls, it was a little bit disappointing, but I don't think we can actually read into those falls too much, particularly given the fact that it was a public holiday today. We saw very, very light volumes going through, just over $2 billion in fact. And also we had very light news in terms of economic data out today. At about 11:30 a.m. we did see those ANZ job advertisements coming through, which actually did hit a 19-month high, and as a result we did see a slight uptick in the market at that point, but unfortunately we just traded sideways for the remainder of the day. We did see some strength in some of those growth stocks such as the healthcare sector and the IT sector, but of course it was that materials sector which continued to weigh down, particularly those iron ore miners and those gold stocks, and of course we also saw those financials and the major banks really coming under pressure yet again today. So that really was a continuing theme we saw last week. Last week we saw the materials and the energy sector, the two worst performers. So that will certainly potentially be a continuing trend this week, and will certainly be something we will be keeping an eye on. But unfortunately a fairly disappointing day. But as I said, I don't think we can read too much into some of those falls today.
But why the concern in particular around the miners, and does it continue?
James, look, if we look at some of those iron ore miners, we're seeing them still coming under pressure. We've seen that iron ore price slowly starting to stabilise over the last few trading sessions, but it is still trading below $80 a tonne. So I think there is still a lot of concern out there from investors about a potential slowdown in the Chinese economy. Today we saw Atlas Iron down 5.3%, Fortescue was down 4.3%, and BHP and Rio both down over 2%. So really continuing to be hit quite hard, and that's actually despite seeing that manufacturing data coming through, which we saw last week, which is actually fairly stable. So it is concerning, but I think investors are still concerned about the potential impact on a lot of these miners. In our view, we actually think that coming into the end of the year we should start to see a pickup in that iron ore price, particularly looking at these very low levels of the iron ore price. That is going to start to push out, I think, some of those higher cost producers, particularly over in China, but of course that puts pressure on the likes of Atlas Iron and BC Iron. So obviously when we see that excess supply potentially leaving the market, that will drive that iron ore price higher. So that is one factor, but also looking at that property sector over in China, we know that has been one of the areas which really has been impacting that iron ore price. So I think if the government starts to recognise this and we do start to see some stimulus measures being implemented, again I think that could increase demand over in China and potentially push that iron ore price higher. I do think in the short term we can potentially continue to expect this volatility, particularly around a lot of media reports and some soft data, which really is pointing to a potential slowdown in the economy. But long term we actually do think it will start to stabilise and pick up again. We have a long-term average on the price of about $90 a tonne. So hopefully coming into the end of the year we should start to pick up again.
Does that somewhat cautious optimism extend to the subsector of gold, which was absolutely hammered with the price looking, sadly, rather comfortable below $1,200 an ounce?
James, that's right. We really saw those gold miners coming under pressure today, now fallen below, as you say, $1,200 an ounce. We're down about 38% since we saw the gold price peaking back in September 2011. So really has put a lot of pressure on some of those gold stocks. And I do think that we potentially will continue to see downward pressure on that gold price. I think investors are a little bit cautious, particularly as the Fed starts to wind back that bond buying program. We know quantitative easing is coming to an end at the end of this month, and also there are continuing talks around the US increasing those interest rates. So I do think that is going to continue to put pressure on those gold stocks. Investors aren't going to be buying into those safe haven assets like they were post the GFC. So I do think that will continue to put pressure on a lot of those gold miners. I think in this space investors probably need to focus on some of the lower cost producers. We still think there is potentially some value in some of those stocks despite seeing that fall in that gold price. But as I mentioned, I do think that gold sector will continue over the sort of short to medium term, definitely coming under pressure.
Any standouts though within the space listed gold players on our market that you do like?
James, if we have a look actually at the performance today, we seen those gold stocks under pressure, but of those ones that really took a fall, we actually quite like the outlook for Northern Star. Northern Star was one of the worst performers. It was down about 11% today. But if we look at this company, the underlying fundamentals actually look quite strong. Despite being very highly leveraged to any volatility in that gold price, they actually recently reported a very strong result. Their Jundee gold mine over in Western Australia looks very strong. Last week we saw some pretty strong drilling results coming out of that company, and of course there might be a potential to extend the mine life of that gold mine as well, and the company's actually said that they are expecting to get some more gold out of that mine. So that remains pretty positive in our view, and actually we quite like the outlook for this one. It is a lower cost producer and potentially might have the opportunity to start paying dividends over the next couple of years. So certainly stocks such as this we actually do quite like, despite seeing it coming under pressure and potentially seeing that gold price falling even further. Some of the underlying fundamentals, if they can focus on their low cost production and further exploring, then I potentially think they might be able to defy some of that gold price volatility. So that is potentially one we quite like, particularly after the falls that we did see today.
You mentioned obviously the importance of Fed policy when it comes to the outlook for the gold price. Just more broadly with the US, a lot of commentary at the moment about the inevitability or the looming, if you like, correction in US markets. I mean, is that something that you foreshadow?
James, there really has been a lot of talk about this lately, but of course we saw the US rebounding on Friday quite nicely off the back of that very strong US data. So it just is so hard to predict the movement of markets at this stage, but I really think this is implying that volatility is starting to come back into the market. We saw back in September for the month, we saw volatility had increased, and I do think we can expect that for October as well and going forward. So I think the more we start to see this volatility increasing as quantitative easing comes to an end and we start to see an increase in those interest rates, then I do potentially think that is going to trigger some profit taking in markets and certainly continue to put downward pressure on markets. We know that a lot of investors are actually sitting on multi-year profits at the moment. So I do think the more we expect to see that volatility increasing, I think that will continue to put pressure. Last week we saw that small cap Russell index over in the US actually entering correction territory, and there was some concern that some of those large cap stocks will actually follow. So that will be something we will be keeping an eye on. Last week we also saw Charlie Aitken actually releasing a note on a warning about a potential US correction. So that may have triggered a bit of uncertainty as well in the market. He believes that in the wake of a lot of falling commodity prices, emerging markets falling, a lot of those internet stocks as well coming under pressure, and of course the strengthening US dollar as well, that all potentially could be a trigger for of course this volatility increasing and a potential trigger for a correction. But if we do look at the performance of some of the markets, the S&P 500 down about 2.2% since its peaks, the Dow down about 1.8%, the ASX 200 down about 1.5%. So still would be a long way to go if we were to see a 10% correction. But as I said, so difficult to predict the direction of the markets. But I think one thing we do know is that we can expect to continue seeing this volatility increasing.
Absolutely. Look, just taking a look at some other performance, individual performance today. Magellan had a very good session set against, very good day set against a weaker session, up about 4.7% in the end.
James, that's right, and we actually got an update from the company today around their funds under management for September, and their total fund was actually up 6.5%. So really did see investors reacting pretty positively to this news today, and it actually did confirm our positive outlook on this stock. Their funds under management really just has continued to perform very strongly and is continuing to grow, and it is slowly starting to become a leader in that funds management sector, and we do think it is probably quite well placed to benefit from that growing pool of self-managed super fund assets, and also in terms of high net worth retail investors as well. So certainly like the stock, they have a highly regarded and well-run management team. They have a strong track record of outperforming in terms of their investments, and also some pretty strong distributions as well. And they also have access to a pretty large retail distribution network where we do believe a lot of their funds under management will start to come from in the future. So overall, it's actually had a very strong performance. It's up about 20% over the last year, up about 250% over the last couple of years. So we do actually expect that to continue, certainly if we can continue seeing their funds under management increasing.
All right, Leanne, as always, great to get your thoughts. Thanks very much.
Thanks, James.